Welcome to the CLS Monthly Market Review. I'm Rusty Vanneman, Chief Investment Officer at CLS Investments. And with me this month is Grant Engelbart, Director of Research and Senior Portfolio Manager. Welcome, Grant.
Thanks for having me, Rusty.
Well, we have a few hours left in the month, but when we look at the 4-week returns, it looks like it's going to be a pretty good month. I don't think a lot of people really feel that way, but the U.S. market is up nicely. International markets are up more, particularly emerging markets.
Right.
Bonds are even up. Commodities are down, but it's been a pretty good month. What are some of the reasons why the market has had a good month?
Well, a couple of recent comments actually this week from the Fed and expectations for Fed rate hikes have kind of given a boost to the market. So previously there was an expectation next year of 3 to 4 different rate hikes. Powell has kind of hinted this last week that we're closer to neutral than maybe expected, and that's really kind of given a lift to the market. There's hopes of some, of the trade talks wearing off and some hope for the G20 meeting this weekend, positives coming out of that. But the Fed has really been the driver, I think, of the recent rally that we've seen. It's been good for a lot of portfolios.
Absolutely. I think because of that, we should expect, it's not a guarantee, of course, a decent December and probably a pretty good start to next year. That said, performance this year, it has been tough for investors, 3 different reasons. The first reason, of course, is that the markets are down in general. If you look at all the asset classes around the world and all the different asset classes, you've got a good stat on that?
Yeah, there's one measure that the most asset classes, I think 89% of the asset classes surveyed by one provider, which is the highest number that has been down since 1901.
That's amazing. 1901?
Which is incredible.
Yeah.
So a multi-asset class investor like ourselves, it makes it very difficult. If you look at our asset class sectors and strategies, we have over 100 of those. Yeah. There's only 22 of those that are higher this year. And then only 6 of those are higher by more than 5%. Over half are down by more than 5%. So it's been a tough go any way you slice it.
I knew you had some good stats, but you delivered well on that. Hey, so of course the second reason is, as you kind of mentioned, for global investors, international markets have been down. They've been down, depends on the market you're looking at, more than 10% down more than the U.S. markets. And then the third reason why it's been tough, actually at CLS, some of our portfolio tilts have not worked this year. And there's the international investing tilt, international markets, and then also the value tilt. But we like those areas a lot, as much as we ever have. And tell us why.
Yeah, it's expected returns in our calculations for those areas are much higher. So international markets, 2 to 3% higher expected returns in general broadly versus the United States. And if you look at the value-oriented side of international markets, it's even higher than that. And then emerging markets, we're looking at 5%, and then some of the 5% more expected returns over the coming years than the U.S. market, which really adds up. And if you look
5% per year for 10 years,
exactly,
right,
which is substantial. And then the way we've sliced emerging markets into more value-oriented areas, that's 8 to 9% higher expected returns, which is really remarkable. And value versus growth domestically or internationally is very similar as well. So value stocks domestically, we expect quite a bit higher returns than growth, upwards of 5% as well. So that's what we're looking at, and that thought is shared by a lot of providers out there as well. So we're not alone in thinking that the expected returns are quite a bit higher, and in some places have even higher expected returns than we do for those asset classes.
I think that's a great point. Again, we develop our own expected returns for every single ETF, every single asset class. We generate those every single day. And it's just not us. It's value-oriented shop, it's growth-oriented shops, it's style-agnostic shops. They've all basically come to the same conclusion. So, well, another question we get a lot is, first of all, CLS is an active manager. We make active decisions. And people ask, how do you define an active management style?
Right.
How do you answer that?
Yeah, I think there's 3 kind of glaring ways to look at it. First is turnover. And turnover specifically is the lesser of buys and sells, which is important to note. So if you continue to sell out of a portfolio, let's say, and you have 100 sells and you only have 1 buy, that buy is what counts for your turnover. So it's not just liquidating or adding cash or whatever it may be, it's the combination of those things. There's also the year-over-year asset class changes, so the movement in how our portfolios are positioned, and then just the pure number of trades that happen throughout a year are kind of the most apparent ones.
Yeah. So kind of on that point, so in terms of turnover, what is our typical turnover at CLS Investments?
Typically 30.
For our core strategies.
Right. Typically 30 to 40% to 50% or so
Yeah.
across portfolios, depending on how we've been. And, we generally are on the lower end of that but I think a lot of that has to do with how we've been positioned and how we feel opportunities are presenting themselves. And some of those, the ways we've been positioned towards international emerging markets, et cetera, have been helpful in this recent downturn, that we were positioned ahead of that in those markets.
Yeah. So when you have turnover of 30 to 50%, that basically means we're holding positions for 2 or 3 years on average. Again, as you mentioned, those numbers have come down a little bit recently, only because, I mean, volatility, even though it's ticked up this year, in the last couple of years, it's still been well below average.
Right.
You need volatility to create opportunities. And also, we have a lot of unrealized gains on the book, and that kind of slows things down
Yep.
a little bit, too. Well, there are 2 other measures we look at, of course. Defining an active manager is something that we look at all the time. It's not something we always publish because it's kind of a technical, statistical sort of things. We do look at tracking error, and we also look at a measure called active share. And these are really measures like how different are we than our benchmarks, how different are we from our competition, how different are we just from the market in general. So those are really important numbers we look at to make sure that we would qualify as an active manager by virtually everybody's definition.
Right.
And basically, we've satisfied all those this year.
Right.
So anyway, well, thanks, Grant, for coming on today.
Yeah, thanks for having me.
And thank you for your time and trust in CLS Investments. Happy holidays.